All right, let's go ahead and take our seats for our final presentation. Next up, we have Thomas Hogan. Thomas is currently a senior fellow at the American Institute for Economic Research. He's an incoming professor at the University of Austin. He is the former chief economist for the Senate Banking Committee in the U.S. Congress. He's worked for Merrill Lynch in their commodity trading group. He's been a consultant to the World Bank. He's been a research fellow at the Cato Institute, among many others. Believe it or not, there are many other affiliations and appointments that I'm skipping over and introducing Thomas. So thank you so much, Thomas, for coming and joining us today to talk about the history of the gold standard and how that relates to asset-backed currency. Please welcome Thomas.
Yeah, thank you. Great. Thank you, Nevin, for inviting me to talk, and thanks everyone for being here. So as Nevin mentioned, I'm a professor of economics, but before I became a college professor, I had a career for a little while in finance and computer programming. And so, then I was doing programming and finance, and now I'm doing money. And so it's like this perfectly overlapping Venn diagram for crypto. I'm super interested in Bitcoin and crypto and DeFi in particular. And so it's been a pleasure learning about the Reserve Protocol and seeing all the success that you guys are having. I think it's fantastic. So sure, you can clap for that if you want. So I want to talk today about something that I know a lot of people don't really know about, which is the gold standard and maybe what we could learn from it for crypto and DeFi. So the whole crypto experiment is about having money without government, right? And so it's a little bit unknown. We don't know what's going to happen with this. We don't know what direction it's going to go. But I think it's useful that we have had other periods of money without government. In fact, for most of US history, we had money that was created and managed by the private sector. And so, what could we learn from that that might teach us some lessons for today? That's kind of the main idea of this talk. So I'm going to cover a bunch of things, and each of these topics I could talk about for hours, right? But I'm going to do just like a flyby and just try to get as many points in as I can so that I hope they will be interesting to some people. If there are things that I skipped or you want to know more about, feel free to grab me later, or we could have a discussion tomorrow about it. But I'm going to start off talking about the evolution of money, and then some things specifically about the gold standard, like what is it? How does it work? I know most people have heard of the gold standard and kind of maybe know a little bit about it. But as Joseph mentioned earlier, when there's no central bank to do something, somebody's going to do it. And so thinking about how did this work in the real world, I think is important for us. As someone that's interested in free markets, a lot of times when I say, look, the government doesn't need to do that, and people say, but if the government doesn't do it, what's going to happen? And I'm like, I don't know. I just know that markets are going to come in, they solve these problems. Most things, we don't need the government to fix it. But I think it is helpful when you can look to history and say, well, I don't know what will happen next, but I know how it worked in the past. And so we can look at these mechanisms and see what people did in the past, and maybe some of those ideas will be also useful to us in the future, right? So we'll talk about how the gold standard worked and how successful was it in US history. And then we'll talk a little bit about free banking, which also was something that goes along with the gold standard, where you have banks issuing the currency. That's also important during this period. And then just at the very end, touch on a couple of things about what maybe we can learn from this. I don't have all the answers, but I just want to make a couple of points that I think might be useful for the Reserve Protocol, okay? So to start off with this idea about the evolution of money, I think a lot of people, if you had economics, maybe you learned a little bit about how money evolved from trade. So you start off maybe in a barter situation where it's I'm a cook and I'm baking bread and I need some corn or something in order to make my bread. But the farmer that has corn, he doesn't want bread, he needs horseshoes, and so I have to go to a smith to get the horseshoes, right? So I've got to go this whole barter thing where I give bread to the smith and he gives me horseshoes and then I give them to the farmer in exchange for wheat, right? And so when you're in a barter situation, you have all these difficult transactions that are just really hard. And what Karl Menger, basically the first Austrian economist, argued was, well, look, these things can naturally evolve into money because as people trade, you find out, well, look, I don't have to do all these trades. trades. I just have to find something that a lot of people want. And as people trade over time, there tends to be like one thing that everybody wants to use, and then they converge on that thing, right? It's like everyone in crypto knows about network effects, that once you get a couple people using the same technology, the more people you add to that group, the easier and better it is for everyone, right? And so over time, you get into a situation where we're now all trading money for all these different things, and I don't have to think about bartering with all these particular individuals, right? And of course, if you're trading some different type of commodity, people are going to tend to emerge or gravitate towards the thing that's easiest and most useful, right? And so this is like the standard story of how we end up getting money is it evolves over time through some kind of market process, right? There are some people that would say like the government did it, but I'm skeptical of that. So if we look at what people use as money over time, there were a lot of things. One of the most ancient forms of money was cattle. There's something that everybody can use because they're food, and you can transport them because they walk, and it's something that you can use for trade. And in fact, in some early Greek laws, they actually have the fines, like if you break the law, you can pay your fine in cows or goats or maybe chickens. So there's like an implicit cow to goat exchange rate in their system, right? Cow to chicken exchange rate. But all kinds of different goods were used in different societies. There were a bunch of different types of foods that were used. Wheat and grains were something that's easy to transport. They're storable, easily divisible. And so that was a pretty common one. Shells were another common one. Human teeth, not common, but right, we've got all these like weird examples of things that people used, but then they tend to move to something better once something better comes along, and eventually almost all these societies all over the world converge on gold or silver, right? And so again, some people would say like, oh, the government did this, or maybe in an econ textbook, they're like, oh, we had barter, and then the government gave us money. And no, I don't think that's really how it worked. I mean, it might be the case that every king and chieftain around the world happened to have picked gold and silver, but that seems like a pretty big coincidence, right? It's much more likely that the market evolved to using these two metals because they were the most useful, and then the government saw people using those already and started to recognize that as money. I mean, that's what happened in the United States. When we founded the United States, the government wasn't producing money, but we had Spanish dollars that were being traded, and that becomes the US dollar, right? Once we have our US government. So then from these commodities, we get banknotes where banks are willing to give you a piece of paper that you can redeem for the commodity. So then you don't have to carry it around all the time. And it's much easier to just use the paper and have all the heavy metal stored in the bank. Banks also had deposits where they would just record that they owe you some money and you can come in and take your money whenever you need it. Banknotes were, for most of US history, supplied by private banks, and that was pretty successful. But of course, then we eventually moved to central banks. Many of them originally were also redeeming dollars for gold, but then eventually all moved to fiat, right? Joseph mentioned earlier that in the United States, the Federal Reserve was originally a lender of last resort, and that was sort of their primary function. They weren't trying to manage the economy. In most other countries, in most of Europe, the central bank actually was created to sort of benefit the government. In most countries, it was like, look, we need a bank, we'll create our own bank. And then we're gonna give the bank special powers. And then we're gonna need it to issue bonds because we wanna have a war. And then we're gonna have it become the monopoly supplier of money. And then we're gonna think about then maybe being a lender of last resort if there's an emergency. And so in almost all countries, it wasn't like we evolved into central banking. It was the government saw some opportunity that was going to benefit them, and then they sort of slowly over time took more and more power. And so that's how we end up with fiat currency around the world. And of course, because fiat has been unsuccessful, then we move to more recently cryptocurrency. So, Bitcoin and Ethereum and Doge, everyone's favorite currency, I'm sure, and our tokens, right? All these things have evolved because we were unhappy with the way that central banks were managing the money supply, right? So all these are now a new market for crypto, and we will hope that we can have new tokens that are gonna be better, that we're gonna move on to a better type of money supply. I mean, that's why we have Reserve Protocol and our tokens, right, is to try to create a better money. And there is a market where all these things are competing, but individually, they were each designed for a certain purpose, certain reason and logic behind them, right? And we see this, we know for sure that this is how Bitcoin came about, was there's groups of people like the cypherpunks and the extropians that are talking about how do we create a better money? How do we have money that the government can't interfere with, right? And so there are all these examples of even before Bitcoin, people talking about what do we do? How do we create this better money, right? So here's an example, a quote from Nick Szabo where he says, myself, Wei Dai, Hal Finney, Larry White, George Selgin, and a few others, we're on this mailing list called LibTech, and that's where I came up with BitGold, and that's where Wei Dai came up with B-Money, right? These are all precursors to Bitcoin. These are people trying to figure out what are the mechanisms that we should use before Bitcoin. Well, who are Larry White and George Selgin? They are two famous monetary economists that were in this group talking about the gold standard, talking about free banking, and the things that we can learn to develop these protocols, right? This is even before Bitcoin, they're talking about this. So this is Larry White and this is George Selgin. Full disclosure, Larry White is my dissertation advisor and George Selgin was another one of his students. And so these guys are kind of my mentors. And so obviously I feel like there's a lot of valuable things to learn from them. But I'm not the only one. This is Nick Szabo saying, hey, we learned a lot from them. They were important to the development of the first cryptocurrencies. Hal Finney also, he has quotes where he says, George Selgin and Larry White, their insights really shaped the development of early crypto, even before Bitcoin, right? So, they seemingly have some interesting things to say, right? This is an article from Larry White in Extropy in 1995, where he had this back and forth with Hal Finney. Hal Finney wrote something about money, and Larry wrote a reply, and then Hal replied, and back and forth, right? Economics of digital currency, he's talking about in 1995. Right? Which cracks me up because I see people on Twitter, there'll be some troll that'll be like, boomer, what do you know about crypto? Dude, this guy was talking about cryptocurrency before you were alive, right? Larry White has had laser eyes since 95. This guy's been originally part of his ideas helped shape cryptocurrency and Bitcoin. Right? So it seems like, well, if Nick Szabo and Hal Finney think we can learn something from George and Larry and think we can learn something from the gold standard and free banking, then maybe we can too, right? And so that's the idea, is what can we learn from these guys? George and Larry have both written extensively about free banking and the gold standard. They have a ton of stuff, but in this talk, I'm gonna follow some things that Larry White wrote in his textbook about the theory of monetary institutions and his new book, Better Money, Gold, Fiat, or Bitcoin, where he compares gold, fiat, and Bitcoin and talks about which is the better money. I highly recommend this book. It's gonna cover some of the same things that I talk about in this talk, but potentially in more detail, so I would check it out. So I'm also gonna cover some things that I wrote, I'm drawing on a chapter I wrote for this book about the gold standard, a paper that I wrote that was in the Journal of Macro, another paper that was in the European Journal of Comparative Economics. I've had a couple other papers about the gold standard, but I'm just pointing this out to say, I'm not just some gold bug making stuff up. This is serious economic research that was published in places like the Journal of Macroeconomics, right? So this isn't just saying stuff. This is, published in well-respected academic journals. All right, so let's get to it then. So starting off, what is a gold standard? I know a lot of people have heard about that, but don't exactly know what it is. So let's talk first about what we even mean by this. So a gold standard is when we define the currency as being a specific weight of gold. Okay, so before we went off the gold standard in the United States, the official price was about $20 per ounce of gold, which means $1 is worth about 5% of an ounce of gold, right? So you can go into a store and you can give them a 20 or you can give them an ounce of gold and it's the same thing. Those are literally the same. If I have a $20 bill, I know that I can trade it at any time for 1 ounce of gold. I can go into my bank and they'll give me the gold. I can go into another shop and spend it as if it was gold. It doesn't matter, right? Those things are literally the same. A dollar means 1/20th of an ounce of gold, right? Typically, these gold standards have certain characteristics the main one being that money is a commonly accepted, that gold is the commonly accepted medium of exchange. We're using gold as money to make all these purchases. Mostly there is market production in terms of the mining and minting of gold. In a lot of countries, the government at some point took over minting. There are definitely a lot of historical episodes where the government then takes on the role of creating coins and then debases the coins, right, and cheats people out of the value of their gold. When you have multiple countries on the gold standard, it means they implicitly have fixed exchange rates because they've both fixed their currency. You know, ours is this amount of gold and ours is this amount of gold. So they implicitly have fixed exchange rates, which means it's easy to trade, right? So there's a lot of international trade in this period. And sometimes you have multiple monies like bimetallism where you have gold and silver circulating at the same time in the same country. In fact, a lot of countries kind of fluctuated over time with mostly gold and mostly silver, depending on what was going on in the economy or different factors, like if the government tried to regulate those things. You know, sometimes all the silver leaves the country for some reason. But I'm not really going to get into that. I'm going to treat this as if it's like one thing, just the gold standard. You know, because gold and silver, if we're talking about the mining and production, it's basically the same. So I'm just going to say the gold standard, and you can think this would apply to silver in the same way. Okay. One of the other things about the gold standard is that you typically have coins, and the coins too kind of evolve over time. So you can think a coin is like, if you wanted to go into a store and you just had some like little gold rocks, then every time you got to get out the scales and figure out, okay, how much gold do I have here? Coin is just a verification of the weight, right? It's like somebody just measured out an ounce and then they just stamped it, right? And they just put this little logo on it that says, this has been verified, it's 1 ounce, right? But that's not great. Like these primitive coins, you know, it's only got one stamp, and it's not very clear, and you can probably scrape some gold away from the edges, right? That's why when you look at your coins, they have these little ridges around the edges. They have milling so that you can't scrape the gold off and steal a little bit, or you can't scrape some from the picture. People will notice, right? And so over time, we developed better coins. This one, I believe, is from the Pikes Peak Mint, which was a private mint in the United States. You can see that the design is a little bit more intricate. They mix it with other types of metals to make it a little bit harder so you can't just chip things off the edge or off the face. And especially when you have competition, then you have insurance because you know that if that mint produces underweight coins, people are going to find out. Right? And sure enough, they did. In the United States, if you had a private mint and you produced coins that didn't have the right amount of gold in it, people would find out and you would go out of business. Right? And so if you have competition, you're likely to evolve to better systems, and you're likely to have cheaters go out of business. Right? And so in the United States, we went through a couple of different types of gold standards. For the pre-Fed, most of the pre-Fed period, we were on a strictly market-based standard where it's all done privately, right? You have private producers digging up the gold, you have some government, but some private mints minting it into coins, and then you have banks issuing banknotes on top of that, right? And so that's what in order to think about the effects of the gold standard and how it works, I'm gonna basically talk about this pre-Fed period where we're mostly private. We did, when we were on the Fed, stay on a domestic gold standard. In the early years of the Fed, for 2 decades, you could redeem your dollars for gold. However, we went off of that in 1933, right? They confiscated all the gold in the United States, except for small amounts for jewelry or coin collections. They were like, bring all your gold in, give it to the Federal Reserve, and we're gonna give you paper. They literally confiscated everyone's assets. So that's pretty crazy. After that, we were no longer on a domestic gold standard, but we stayed actually on this international standard until 1971. We stayed on the Bretton Woods fixed exchange rate standard, which was tied to gold. But then we go off of that in 1971. So we have, like, when people talk about the gold standard, there's sometimes confusion about whether they mean, do we have a central bank? Is it about international exchange? I'm not going to get into all the details. I'm just going to talk about a market system and how it worked, okay? All right, so then how does it work? So we can think of this as, so we can think of this as something that is based on supply and demand. And I think that's interesting because most people that aren't familiar with that before think that this is all random, right? It's like you just discover a whole bunch of caves full of gold, and then it has these big disruptions on the money supply, right? Like here's a quote from David Wilcox. A few years ago when Judy Shelton was nominated to the board of the Federal Reserve, she had previously written some things about the gold standard. I mean, she's like kind of a fan, at least. I don't know if she wants to implement it in the United States, but she definitely thinks it was a decent period. And so David Wilcox, he's critical of that. He says, what would have happened earlier in the year if the economy was collapsing if Shelton's preferred system had been in place? There's no way to know. It would have all depended on whether the gold was flowing in and out of the Bank of New York. So that seems weird to me. Like, there's no way to know. I feel like economists have something to talk about when there's changes in prices and quantity. Like, if the supply is going to affect the price and quantity, like, we can kind of figure that out because we talk about supply and demand, right? And so that's what I want to think about is, how does this work in terms of supply and demand? So I'm going to draw a couple of supply and demand diagrams here. There will be no exam, but just to like give a demonstration about how this works. So this model is like a stock and flow model, not like the one somebody tries to use to price Bitcoin, but a more regular one. So if we think about the market for gold production, production is happening per period, so like ounces produced per year, something like that. And we always do for supply and demand, quantity on the bottom axis and price on the vertical axis. And the price of gold is the purchasing power, like how much stuff can this unit of gold buy, right? And the important thing to think about here is it's not vertical, it's upward sloping. Meaning when there's a change in the price, the producers respond by producing more or producing less. Okay, it's not like you just randomly discover a bunch and that's the only thing that changes the quantity. If you think about any company, when the price is high for that thing, they're going to produce more. When the price is low, they produce less. In a gold mine, you could think about it like you go into a cave and there's some parts of the cave where the gold is just right there on the wall and you can just chip it off. And there's other parts where it's like really hard to get down into the cave and it's mixed with some other metals and it's like really hard and expensive to get to. And so of course what happens is when the price is high, it's worth getting that more expensive stuff. When the price is low, you're like, let's just leave that alone, right? And so you get this response when the price goes up, people produce more. When the price goes down, people produce less, right? It's not all random, right? There's a regular supply curve. This is a market just like any other market, okay? The demand for gold in terms of, since this is production, you can think of this as consumption, that there are some uses for gold that make it basically non-recoverable. We use it in computer parts and then we throw them away. We put it in people's teeth and then we bury them and never, hopefully never get it back. Like you have some periods, I mean, again, it's like when the price goes up, you got more grave robbers, right? Maybe someday we'll get to the prices so high that we're digging up landfills to get it out of computers, but I hope not. That maybe never happens. But that's what we think about in terms of the production demand is for consumption that'll make it go away. There's actually not a lot of that for gold. Maybe that's an advantage. And then the other thing is the stock. And so this question is like, okay, of the money, of the gold that's produced right now, how much is it used for money, right? Because you have some people that demand money. They want to hold it either in their wallets or their bank accounts or be able to go out and spend it, right? And so there's demand for gold. But there's also some supply of the existing gold that turns it from non-monetary into monetary, right? People have gold jewelry and earrings. As the price of gold gets high, you might want to turn that into money. Guys are like, honey, are those earrings worth like a trip to Hawaii? What's more important to me? Because as the price goes up, you might want to use it, right? Historically, it was even more common that there were a lot other uses. People made their candlesticks and their plateware and silverware, that kind of stuff. Silverware now, like potentially gold in the past, right? And so that too, it's like all that stuff, when the price goes high, it's easy to convert into gold, right? And so both of these markets, you can think about, well, there's one price basically that's determining what happens in each of these markets. Okay, so this is basically a regular supply and demand analysis of the stock and flow of gold. We can do just a quick example. Again, this is not going to be on the exam, but we can use this to study all the things that happen in this market, right? So let's say there's an increase in demand. Maybe people want more to put in their bank accounts. Maybe a new country comes under the gold standard. Whatever reason people want more gold, there's an increase in the demand for the stock of monetary gold, right? So that pushes up the price and pushes up the quantity. So that means in production, the price is higher too. So all the suppliers, they're going to produce more. The people that were consuming it, they're going to use less. They're going to put like silver or porcelain or whatever in people's teeth. Porcelain, whatever the non-gold stuff is they use in people's teeth. And then that means that when that happens, there's going to be some temporary overproduction. So you've got more that's needed in this market. That means it goes to the supply and pushes up the supply of gold that can be used for money. And of course that over time pushes down the price, which pushes down the price in the production market until we get back to basically the same price we were at before. The only difference is we've moved up the quantity to accommodate for that increased demand, right? So you get basically a temporary movement away from the equilibrium, and then you come back to what was basically normal before, right? And so the market is gonna respond to any changes in demand by changing the supply to accommodate, right? And you can think about like all these different scenarios, the Goldfinger movie where he's gonna like blow up Fort Knox, right? Or, you know, how would we change? What if we have changes in production? So you can have new technologies for finding gold. The cyanide method was something that changed the way that they produced gold that made it less costly, right? We can think about all these things in terms of supply and demand and not just be like, hey, it's all random. It's not all random, it's a market just like a market for anything else. All right, so that's the important thing there. That's a lot different than what we have with the Federal Reserve, right? The Federal Reserve, you know, there's some things that are definitely different, that might be better or worse. So the Federal Reserve has only aggregate data. So instead of being like a bank that has customers coming in and you have some idea how much money people want, the Federal Reserve is just looking at only aggregate data. So they don't really know like on the ground how many people are actually demanding new money. They just have to like look at what's going on with inflation and what's going on with unemployment. And so they have these very general aggregate statistics to try to make their decisions. So that might be bad, but it might be good, right? People from the Fed would say, no, we have better data. We can make better decisions than regular businesses. I don't know, if you have better data, you can just turn it over to the public and let them make the decisions. But definitely if people at the Fed, they would say, no, this is an advantage for the Fed. The Fed has no profit motive. Again, I would say that that's a problem because if you're a producer, you want to make a profit. That's what gives you the incentive to supply things that people want, right? In any other industry, we would say, oh yeah, private corporations are likely to produce this better than the government. But for some reason, in terms of money, we're like, oh yeah, we want the government to do it, and we want them to have a monopoly. That's weird. We wouldn't say that about any other product. But the Fed would say, no, this is an advantage, right? Because we're not going to try to exploit people. We're going to do what's best for everyone. Maybe. The Fed also has only one money supply to manage. So if you think about the law of large numbers, you know, if you have banks producing the currency, some are going to do too much, some are going to do too little. On average, they're going to get it right. But if you have only one, then when you mess it up, it's bad for everyone, right? It messes up the whole economy. But the Fed would say, but when we get it right, it's better for everyone. Right? And so they would say, oh, these things are an advantage, whereas I would say, like, these are systemic disadvantages for the Fed as an institution. And so, you know, it's hard to convince people if they believe all these things are better for the Fed, then they're going to say the Fed's going to be better, right? And so I think then we can't say, in theory, which one of those systems is going to be better, if the gold standard is going to be better. So then, okay, let's look at what happened in the real world. We'll look at the history of the United States, the performance of the gold standard here. Okay, so then the first thing that's the most important on the gold standard is the price level. So here is a graph of the price level in the United States from 1790 to 1913. It's pretty steady, you know? It's like basically the same at the end of the gold standard period as it was at the beginning. So that is pretty good long-term stability there. But you do have these big fluctuations, right? You have these certain periods where it just blows up. And so I think people, you know, this is where someone might say, that's where we had a discovery of gold, right? It's like the gold rush in California. You know, 48, they discover gold at Sutter's Mill, which is like by Sacramento. It's like not far from where we are, right? 49, everyone rushes in, starts producing a ton of gold, and then you get a bunch of inflation in the 1850s, right? You guys see that in the graph? No, actually not. This is the period of the 1850s. No inflation at the nationwide level. Now, maybe you have some inflation in California where all the new money is coming in, but then you probably have like a David Hume-style price specie flow mechanism. You know, prices go up in California, that makes stuff in New York cheaper. They buy stuff from New York, money flows to New York, stuff flows to California, everything equilibrates, right? And so no inflation during that period in like the biggest gold discovery in US history, right? Joseph mentioned earlier, I think that there's the other biggest one that people ask me about is When they discovered the New World and Europeans start importing all this gold back to Europe, there was what they called the price revolution in Europe. Sure enough, like what happened is all this new money comes into Spain, prices go up, they start buying things from other countries, and pretty soon across all of Europe, prices rose. They basically tripled across Europe. That happened over the period of 75 years. So that's about like 1.5% inflation. You know, the Fed's ideal level is 2%. Right? So I'm like, you're right. The worst period ever of inflation in the world is even better than the Fed's ideal target, right? It's lower in the worst period of the gold standard. So then if the gold rush didn't cause this, what did? Well, what happened in 1812 and again in 1861? A big war, right? And these are periods where we suspended the gold standard. You know, the government would temporarily go off the gold standard and print money to win the war and then go on after it finished. Is that a problem? I don't know. Like, I don't have a strong opinion on this. I think some people would say, like, look, that's part of the gold standard that's bad. We don't want that. Certainly, Adam Smith argued that shouldn't be allowed. Adam Smith argued we should only be financing wars through taxes, because what happens is the government gets in all these wars and they benefit all the rich people, and all the poor people are the ones that pay the price, right? So maybe, I don't know. I think the system that worked here, at very least, it maintained the expectation that we were going back on the gold standard. When these wars happened, everyone trusted that after the war, things are going to go back to normal, right? Even if it takes a decade for prices to come back down, people believe they have this long-term anchor that they know if we go back to the gold standard, we're going back to stable prices, right? So at very least, it at least anchored people's expectations regardless of whether we think that's a good or bad event. Okay, so it's not great to have these deviations, but over the long run, like incredibly stable, right? So we can compare that then, all right, what does it look like under the Fed? Not so great, actually. So, I mean, in the early Fed period where we're still tied to the gold standard, for the first few years, we've got a domestic gold standard, and then we stay on the Bretton Woods system till 71. But once we go off this international tie to gold, then it's like, boom, we're off to the races, right? And so that's when you see the worst periods of inflation. So if we were to look at the numbers here, what we have is almost no inflation on average in the gold standard, and about 3% average under the Fed, right? But I think people from the Fed know this. But they would say like, oh, well, inflation is a little bit higher now, but what we've done is we've reduced the volatility of inflation, right? That's not true actually over the whole period. I mean, it's a little bit lower, but not statistically significant difference. But if we break this into the Fed managed gold standard up to 71 and then the fiat period after, actually that is a correct statement, right? We do have higher average inflation and lower, statistically significantly lower deviations. I don't know, is that bad? Like, so it's not clear, it's not obvious from an economic perspective whether this was a good trade-off. First of all, it's not obvious that the Fed actually lowered the standard deviation here. I mean, it's certainly true that the Fed did a better job in the 1980s and 90s, this period we would call the Great Moderation. But there was a lot of other things that happened, and there's a bunch of Fed papers that try to discover, like, how much was our role in bringing about the Great Moderation? We didn't have any oil shocks, we didn't have any major wars, we had all these changes in IT, we moved to a service economy, all those things reduced the volatility in the economy, right? And so you should get some natural reduction, and how much, like, it's hard to say. And so maybe the Fed caused this reduction in volatility, maybe they didn't, right? But I'm not actually sure that that is the best measure of volatility. You know, when they look at the standard deviation, that just means that, well, look, in the Fed period, it's consistently going up and up and up, whereas on the gold standard, it's like up and down and up and down. That doesn't seem that bad. I mean, especially if everybody knows that's going to happen. I think the other thing that is potentially more important here is the long-run stability, right? If you think on the gold standard in the long run, we know that prices are going to be stable. We know that prices are going to come back down. Even if we have a war or something like that, they're going to come back down to basically what they were before. That's really important. That's really important for people to be able to plan their lives. You know, in the short run, it's like they know prices went up one year, they're coming back down next year. It's nothing weird. It's something that they can plan for, right? But it's really important because they can make long-term plans during this period. So we see in the 1800s, companies making these extremely long-term projects, 100-year projects. There were several companies that issued 100-year bonds in that period because they're so confident about the price level is going to be the same. I know that what's going to happen in the economy here. There were a couple companies that issued 1,000-year bonds. 1,000 years, right? They're planning for 1,000 years from now. There are a few of those that still pay today. There are a couple of bonds that have been paying for over 150 years, and you can still buy and own that bond and earn a dividend because those companies were so forward-looking because they knew they had certainty about what was going to happen in the economy. And so I think that actually is a lot more important than just the up and down, standard deviation. And so there are studies that look at this and say, okay, so the problem in the Fed is that you have this persistent inflation, but you don't know how much it's going to be. It could be 2%, it could be 5%, and that affects the price level a lot, right? 2% inflation over 100 years is like a 600% increase. But 2.5% is a 1,000% increase, right? So just a small change in the inflation over time is just exponentially huge. And so you just can't make long-term plans in the same way that you could in the gold standard period because you don't have certainty about the price level, right? So from my perspective, the Fed has created a higher rate of inflation. They have reduced the volatility of inflation, but they've also reduced our certainty about the future, okay? This trade-off, again, I think some people from the Fed, they would say, like, yeah, we know the rate is higher, but we've reduced volatility, and maybe we're okay with that. Again, it's not clear that they caused that or how much they caused it, but I understand why they're making that argument, right? The same thing is basically true if you look at GDP. GDP growth has been a lot lower under the Fed, even if you just look at the most recent periods. The volatility in terms of standard deviation is also a little bit lower. It's hard to tell, like it is statistically significant, but just barely, and it depends on the periods you measure and stuff like that. But I think the bottom line here is, what do you think is gonna be indicative of the future? The Fed would say, the Great Moderation, we figured it out. We figured out monetary policy, we're good at it now, we're good at keeping inflation down. But, then we have the 2008 Great Recession. It's like the greatest downturn since the Great Depression. They would say, yeah, the Fed, we came in and saved you, right? Like Ben Bernanke, that was Fed chair at the time, he has this speech where he says like, the Fed pulled the economy back from, hold on, let me think how it goes. The Fed pulled us back from the precipice of a worldwide recession, right? Like the world, we saved the world, And a lot of people have bought into that, right? I think a lot of people would believe that, yeah, the Fed saved us in 2008. I'm like, the Fed caused that, but they have been good at selling this narrative. Same thing for the post-COVID inflation, right? People would say, like, look what a great job. We're getting the soft landing, right? Look how awesome the Fed is. I'm like, the Fed caused the inflation, So it seems weird to give the Fed a lot of credit, but what you think of those cases, like what you think of the Fed's recent performance is really gonna determine what do you think is gonna be going forward, right? Like I would say that they've made some pretty big mistakes, but other people would say, no, look what a great job they did, right? And so that really colors people's views about it, I would say. Still, I think some people kind of are overly critical of the gold standard. So this is a quote from Paul Krugman, winner of the Nobel Prize. Some people may have heard of him. So he says, anyone who believes that the gold standard era was marked by price stability, or for that matter, any kind of stability, just hasn't looked at the evidence. Like, wait, we just looked at the evidence, and it looked like the price level was pretty stable, so that seems like a pretty strange claim to make. Another economist, Anil Kashyap, says, love of the gold standard implies macroeconomic illiteracy. Like, whoa, that's pretty bold. I mean, he was working at the Fed, and his boss's boss at the Fed was Alan Greenspan, who also said good things about the gold standard. So it's weird to call your boss's boss illiterate. I don't know, that seems like a pretty strong statement. So then why do they think this? Again, I think that people's views are colored by what they think the Fed's recent performance has been like, and these guys would both say the Fed did a good job. I mean, like, obviously it's not true to say marked by any kind of price stability. It was long run stable under the gold standard much more than under the Fed, right? But But there are other reasons here. I mean, another reason is like the Federal Reserve employs the majority of monetary economists in the United States. So they basically run the show and dictate the opinions that you're reading in academic journals and in the newspaper and on TV, right? They really kind of control the narrative. But another thing is that I think a lot of these guys just haven't looked at the research, right? Like if you're a monetary economist today, the Fed is important to you, and thinking about what would happen before the Fed is just not important, right? And so people just haven't looked into that, except for monetary economists and economic historians. And so they actually, most people that have looked at data do have a much better perspective of the Fed. But there's another thing that this set of opinions changed fairly recently, recent in like economic research terms, which I mean like 40 years ago. So this is Christina Romer. So Christina Romer was the chair of the Council of Economic Advisors under President Obama. So, just to say, like, she's a big Democrat. She's clearly not a big gold bug or a right winger or any kind of crazy, right? She's like, was at Harvard and then now at Berkeley, very serious, widely respected economist. So she had these papers in the 1980s where she looked at the data and she said, you know what? This claim that things are better under the Fed, this is actually just a figment of the data. It turns out what happened was in the 50s, 60s, 70s, when people were saying, oh, the Fed's doing so much better, they were looking back at the pre-Fed period and trying to make these comparisons, and the data that they found from the pre-Fed period was the only data that was available, which was commodity prices. Well, everyone knows commodity prices are more volatile than consumer prices. Right? So they were looking at this volatile price level and therefore had a non-representative measure of what prices were like. It's also true of GDP. The way we calculate real GDP is we look at the nominal number and then we subtract out inflation. So if you got an extra volatile inflation number, it's going to make it look like real GDP is volatile as well. And so what Christina Romer found was like, actually, if we go back and we get a better measure of prices, the Fed, it turns out, is not any better than the pre-Fed period. So she says the severity of economic fluctuations on both sides of the Great Depression are roughly equal. She had a paper all in the mid-1980s in the AER, which is the top journal in economics, the JPE, which is a top 3 journal, the Journal of Economic History. Other economists followed on this. There are papers throughout the 90s and into the early 2000s that all do the same thing, go back and get better data from the pre-Fed period, and they all find the same thing. It's actually not that bad. If we look at the fluctuations in unemployment as well, it's actually not that bad. So it doesn't seem like the Fed has really been able to improve economic performance once we're looking at the right data. And another paper from 2008 that used more advanced econometrics found the gold standard did at least as well in creating economic stability. 2008, this paper was probably written in 2006 or 2007, so if you include the 2008, Great Recession, then probably the Fed looks even worse. Okay, so that's what I think is like actually the gold standard period. If you think about how it works as a market, if you look at the evidence, it looks like actually it worked pretty well. But the thing that we haven't talked about yet is banking. We haven't talked about the issuance of banknotes and what effect that had. So I want to get into that for a few minutes. And again, I'm just going to do like a very quick overview of this. So free banking is also a thing that I think a lot of people have heard about or talked about. And what does that mean exactly? It doesn't mean that it was like anarchy and there's no laws or no regulations. There's like never been that kind of situation in the world, but there have been a number of periods where we had relatively low regulations, and one of the most important things is low barriers to entry, right? So it's easy for new banks to come in and compete, right? The competition is the most important thing here for disciplining potential bad actors, right? So having lighter regulation and having low entry barriers is really important. Okay, during these periods that we're talking about free banking, one of the important aspects is that we have private banks issuing the money, right? So again, for most of U.S. history, we had private banks that issued money, usually redeemable for gold. In some other countries, it was redeemable for some kind of fiat currency or something like that. Like in Scotland and Ireland, they had redeemable notes for British pounds, right? Even after the Bank of England became a monopoly, became a central bank. But at least in the US, it was always like redeemable for gold, okay? So here's an example of that. This is from the Pittsfield Bank, which is a private bank in Massachusetts. So, you can see this is a pretty old one. It looks a lot like the greenbacks that we eventually got from the US government. This is a more recent example that banks in Scotland and Ireland still today issue their own private currency, but again, it's redeemable for fiat money. So it's not quite the same as being on the gold standard, but they have more license to do creative things. They can, make up banknotes that don't just have the presidents, or for them, like the kings or whatever. So in Scotland, they put Robert the Bruce, famous Scottish hero. And you see this on other notes where they'll have like astronauts or famous soccer players or whatever, that they can put whatever they want because they're allowed to do that because they're a private corporation rather than the government. Okay, so there have been a bunch of these periods of free banking, and so we have a lot of illustrations from around the world. But in the United States, the period that most people refer to as the free banking period was from 1837 to 1863. 37 was the end of the Second Bank of the United States, which wasn't actually a central bank. And so you could say even before 37, some of these states were free banking. But the point is, for this early period, before the Civil War, we had a state banking system where all the regulation was done at the state level. And so it's great because we can compare how different systems in different states worked, right? After the Civil War, we switched to a national banking system where basically the government forced all the state banks to convert to national charters. So so here's a couple of characteristics of this. So one of the things is that the banks accepted each other's notes at par. So $1 is $1, right? It might be that if a bank was going to fail, they say, look, we can only give you 80 cents because we're worried that we won't get the money back for this note, right? But that's important because I hear people say, if I say something like, we could have 1,000 banks issuing their currency, and people are like, that would never work. And I'm like, well, it did work. So one of the secrets was that they would say, we'll accept at the face value, right? And one of the ways that they were able to do that is they would create these clearing systems where they all get together, and it's like, if I'm JP Morgan, I accept dollars from Bank of America, and they accept mine, and then once a week or every day or whatever, we get together and then net them out and say, okay, it turns out you owe me 1,000 pieces of gold, 1,000 ounces, something like that, right? And so sometimes that's the banks getting together and creating a clearinghouse, which was interesting because then they can all regulate each other and do some things like last resort lending that weren't possible by any one of them individually, but they could get together and create these other facilities. Some of them also had kind of like deposit insurance. And another option was to have bankers' banks where you had some other entity that was in charge of them, and the banks would all have deposits at the bankers' bank. And this too, you could have competition among the bankers' bank. It wasn't like a central bank that controlled everything. It was like a market where people have choice and they can choose the system that best suits them, right? And so competition is the most important thing that's disciplining banks during this period. This also creates systemic benefits. So the banks would co-regulate because they know, if we're trading notes and I know that I'm going to have to get some money from you later, you better be safe, right? I don't want you to crash before I can get my money back. And so they would regulate each other. You might think that's actually potentially better than the government doing it because the banks know where the risk is happening and how to look for it, right? This also constrains note issuance because no one bank can issue too much. What happens is if you overissue notes, then your notes become a bigger portion of the money supply, people come in and redeem them, and then you lose all your reserves and potentially go out of business, right? In fact, sometimes people would try to bankrupt a bank by storing up all their notes and then going in and redeeming them all at once, right? And so you had to be careful if you're a bank not to get into that situation. Here's a map of all the banks in the United States. Again, it's regulation at the state level. So this doesn't show it well, but you get basically states that have more free banking and more free markets have more successful financial systems, more economic growth. This is another thing that I wanted to show. So this is a graph of the money supply in the post-Civil War period in the US and Canada. In the United States, that's this line that's kind of smooth. Smooth is bad here, actually. We would rather have, this is the Canadian system that's got this sawtooth pattern because money demand is cyclical, especially during this period where you have a lot of farming. Farmers take out a loan at the start of the year, buy crops, sell the crops at the end of the year, repay their loan. So it's good if you can have a money supply that's going to be adjusting. Ours, because of regulations, banks weren't able to adjust their quantities of money and the money they were issuing, and so they got the smooth line, which is not as good, prevents growth, and potentially inhibits economic stability. So so these systems, I think, helped to make the banking system more stable during this time. But there were still a lot of failures. There were a lot of bank failures and in some cases big financial crises. But those things weren't caused by the gold standard. I've seen some people from the Fed and people that are just critical of the gold standard be like, oh, did you see all those bank failures? Yeah, but they were caused by a bunch of things. One of them was the banks were required to hold all these bonds. Like I showed you in the previous slide, the money supply couldn't fluctuate, right? That's in the post-Civil War period. In the pre-Civil War period, this was even worse because the state banks would force the banks to hold state bonds, and a lot of those states got into trouble and couldn't pay their bills. So that causes all the banks to fail, right? That's a regulation that caused that failure. It's not the gold standard. Another example of this is that most states restricted branching, and some of them, if you opened a bank, you couldn't branch at all. You could only have one bank. So that makes it impossible to diversify, right? If you're in a small farming town, all your loans are farm loans. You can't send some money to New York. You can't invest in bonds from other states, right? So if there's any local crisis, again, like a crop failure or something, all the banks go out of business. It's not the gold standard. That's a problem of regulation. Deposit insurance was in some states required and government mandated or run by the government. That causes moral hazard. Banks take too much risk. We see in states that have private deposit insurance systems, they're safer. They have fewer bank failures. Wildcat banks is also something that Gary Gensler, also from the SEC, said this lately. He's like, crypto is like when we had wildcat banking. That was a thing. There were these banks that they called wildcat banks where they would set up a bank, take people's money, and then just run away with the money. Obviously, that's bad, but that was actually pretty rare. It's a couple of famous stories of that happening, but if you look at the numbers, it's not a big deal. I mean, there's fraud in the banking system today, right? And so it's not like the government has eliminated fraud, and it certainly wasn't a big problem in the past, in the wildcat banking period, okay? Banks also did a lot of things to try to prevent failures in different ways. I'll just say a couple things about these. So if they're worried people think they're gonna fail, they can publish how much assets they have and be like, look, we've got your money. You don't have to do anything. You don't have to run on the bank. If people did run and want their money back and they ran out of money, they would just suspend redemptions and say look, we don't have your cash right now, but we'll get it for you tomorrow. Right? It's not guaranteed that they're going to fail. I know everyone has in their head this idea that bank runs were the devil and caused all these bank failures. That's just not true. People at the banks, they knew that was a danger, and so they did things to prevent them from failing when that problem occurred. Unlimited liability was another one. During this period, a lot of banks were unlimited. It's not like when you start a corporation and you buy the stock and the company fails and you're like, oh, my stock went to zero. Unlimited means they can sue you for everything that you own, right? It's not like in 2008 when the bank CEO, causes the bank to fail and gets fired and oh, I got my $20 million golden parachute. No. If it's unlimited, they can come and take all of your money. So you're gonna be a lot less risky if you know everything that you own is at risk, right? So these things would help them to prevent bank failures. But then there's a question of also compared to what? How bad were these bank failures? Ben Bernanke, who is the Fed chair, gave a talk where he said, Joseph said earlier, there were these bank failures before the Fed, and that's why we needed it to come in and act as the lender of last resort. Look at all these failures in 1839, 1907, 1914. The Fed didn't actually open its doors till the end of 1914. So, yeah, that was a problem. But what happened when we had the Fed in the early years of the Fed? Also, we had a ton of bank failures, right? 1921 and in the mid-20s, but obviously the 1930s is when we have the Great Depression. So the Fed was brought in to be a lender of last resort and failed, right? They did terribly. And you may have noticed, I actually changed the axes on this graph. If I put them next to each other, they look like this. Much worse under the Fed, right? This is true even in percentage terms. The banking system grew over this period, but even in percentage terms, they were much worse under the Fed. Even recently, too. There's a lot of evidence that there's more bank failures and financial crises today in the regulated system that we have This one I like. Financial crisis frequency since 1973 has been double that of the Bretton Woods or classical gold standard periods. I underlined Barry Eichengreen as an author of this paper. He's a major critic of the gold standard, but even he is like, look, when I look at the numbers, it just wasn't that bad. Things are actually worse now, right? So that's pretty crazy. Okay, so that's like a ton of stuff. I want to say just a couple of things about thinking about the question of asset-backed currency. Okay, so the model that I used earlier that was like a stock and flow model, I think we can think about a couple of things about what that would tell us for asset-backed currency. And like, you guys are doing a lot of stuff. You know, like Reserve Protocol's got a lot of different goals, and the ugly cash and like, there's a lot of cool stuff going on. So I'm just gonna think about this very big long-term question of, if we had an asset-backed currency, is that the ideal thing to be the right amount of money, to give us the right amount of money for the economy? Like, you can think the ideal amount of money in the economy is, the economy is getting a little bit bigger every year, and so we would like, ideally, for the money supply also to grow exactly the same every year so that supply and demand perfectly meet, right? That's what we would ideally like. And in theory, you know, I like the idea that, well, look, we could just index to everything, and that way we know the amount that everything is growing, and we produce the right amount of money to match that. But I'm not sure it's quite that simple in the real world. So thinking about this scenario with the gold standard, you know, you can think about, okay, we've got some money, and ideally what we would like is a short-term adjustment that is, this is, like, I've changed the shape of this just to show that, like, okay, when the price goes up, people are gonna produce a lot more, right? And so we can adjust in the short term, but also you would like in the long term, we could produce a lot more. And so this might be like the Reserve Protocol produces our tokens, it has a good response to the market, but then also the base money that we're using that is the collateral for those tokens is gonna increase also as the economy grows, right? So that's like one of the questions is, do we have a money supply that when the amount of our tokens increases, does it cause the producers of other stuff to increase as well? Right? So that's hard because you're not starting where you have everything in the economy. So let's look at a couple of things. So first of all, Bitcoin is like the opposite of this. You know, Bitcoin has a fixed supply that doesn't change, right? And this is true both in terms of production. I mean, it does have a difficulty adjustment mechanism. So you have, you know, miners that are coming in or going out and their reward is adjusted, but the quantity of Bitcoin is not adjusted. Right? And this is true also in terms of what's money, because Bitcoin is already a coin that you can trade. And so there's no difference between non-monetary Bitcoin and monetary Bitcoin. If you have something like Ether that's being staked, you know, maybe staking in the Reserve Protocol makes some things non-monetary, but this is not true for Bitcoin. So that's why you get all this volatility in Bitcoin. I think like a lot of people know this already, right? The fixed supply makes the price more volatile because the price only responds to changes in demand, okay? If you think about the opposite of that, if you think about this question of, well, are we gonna have all the currencies and all the assets in the world? Well, that's hard too. You know, it's hard for a lot of different reasons. One of them is like, okay, which assets are we talking about? We're starting off with only crypto tokens, which is definitely not representative of the whole economy. Some of the early tokenization that we're gonna get is probably gonna be financial products, which also is not representative of the whole economy, right? In some ways, it's a little bit like Bitcoin. Like if you were gonna do S&P as the backing for our tokens, you have the same problem that it's volatile, it's more volatile than the regular price level of the economy, and potentially it's gonna go up a lot more than average prices. Right? So the token's gonna be gaining in value, which essentially is deflationary, right? Inflationary means the currency unit is reducing its value. Gaining value means you're essentially creating deflation, which you don't want, right? You want it to be the same growth as the regular economy. And so as you expand the pool of tokens that are available to put into our tokens, you know, maybe it becomes more and more like the rest of the economy. But maybe it's gonna be a really long time before we get tokenization of all these different assets, right? So that's hard. Another thing is quantity adjustments is also important here because, you know, as you expand to different asset categories, you know, you have to think like, how much do we put in part A? How much do you put in part B, right? And I know you guys talked about earlier some different algorithms or some plans for that, but like, man, that's so complicated. I mean, it's just like doing CPI calculations or PCE, and we have this debate over all these types of inflation measures, and it's not obvious. If you compare that to something like one commodity, like the gold standard is like gold and everything else. And I don't have to think in everything else, like how much is in asset A, how much is in asset B, right? It's done because it's everything. And so compared to having a single commodity, this is just like a lot more complicated. Are you having different levels of productivity? So even once you get into like stocks, you can think like, look, AI stocks are going to be a lot different than other types of stocks, and are they representative of what's going on in the economy? You know, like prices of computers and telephones and whatever is all going down, down, down. That's a lot different than the average product in the economy. What about transaction costs? Once you get to the point of tokenized assets and people want to redeem, like that's really expensive. Like I'd like 1 unit of everything in the economy. You know, how am I going to get that transferred to me? Because at some point it's got to be linked to the actual physical asset, otherwise that relationship is broken. That also sometimes makes it subject to speculative attacks. So the idea is like the more complicated it gets, the more people are going to try to exploit it and maybe find a way, especially in the redemption process. So all these things are complicated complications that make doing this hard. But do those things matter? I mean, like this is like the big picture, long run question of when you're solving the problems for the whole world. Like I totally agree, getting on that path from the beginning and thinking about that is a good idea, but maybe that's not necessary today, right? Like if you're just trying to create a stable currency, then maybe you don't care that every single commodity and asset in the world are in it, right? Especially if it's people in Venezuela and Latin America using it, like whatever's happening in the US economy is not the same as what's happening in their economy. They just need something stable, right? So for a while, this question about being perfect is not relevant, right? Getting something that is good and stable and solve some of the transaction cost problems maybe is more important. But also, as discussed earlier, you know, one of the other goals is having like a DeFi token, and I see this as being a little bit different. Like I hadn't thought about this until like Nevin was talking about it this morning, but you know, these goals to me are a little bit different. It's not clear that if you want a DeFi token that's going to create returns and act like an ETF or something like that, maybe that's just a fundamentally different goal than having a stable asset backing a currency. In fact, maybe you can do both of these goals. Maybe like part of the greatness of the reserve protocol is having so much flexibility that you can do a lot of different stuff. Maybe you can have the assets managed as DeFi investments, but people can borrow in whatever token they want. You know, I can have an R token out of gold or stable coins or whatever and feel like that's stable, but on the back end, you have some reserves to back that, but then you have a lot of the other assets in all kinds of DeFi products. And if people want a DeFi ETF, they can have one, but they don't have to. You know, that's a little bit more like, and I say that, I'm like, probably you guys have thought about that. But the reason I say that is because that makes it a lot more like the banking system that was able to accommodate demand, right? If you think about the pre-Fed banking system, they're holding gold, but then they're fluctuating their banknote supply depending on how much people demand, right? And so maybe this is the same idea that, you know, you have some assets that you're holding as collateral and then adjusting the amount that people are borrowing in whatever stable token they want. That means that the money growth amount is much more likely to be matching the increases in demand. So those are just some ideas. The one last thing I was going to say about this is, you know, gold still is a little bit different because gold has a good short-term supply where people will trade their jewelry into coins, but it also has a problem that in the long run, it doesn't respond very quickly. Sometimes it takes years or decades for the mining to catch up with the demand. So it's not perfect either, but it doesn't have a lot of consumption demand. So this is like one other thing to say about commodities is, you know, if you do something like oil's got a lot of production consumption demand. It's got changes here all the time that makes it super volatile. So if you want to use a commodity, maybe using something that people like to store and not like to use is also another good option, okay? So gold's got a lot of great products, got a lot of great advantages. You know, it's not like holding a basket. It's a little bit easier. It's easy to produce. And one other thing is that like gold has a really established reputation. Again, you know, it was on the gold standard, everyone believed we would always go back to a gold standard. And this is not like I'm selling you should do a gold standard. I mean, my typical recommendation when people ask me about money is like, look, we should have free money. We should have competition, use whatever you want. People want to use gold, they use gold. People want to use stable coins, use stable coins. You know, whatever you want, and then I believe like the best thing is likely to win out. If we do that, you know, Larry White, I think he would say, look, if we give people choice, they're gonna go back to gold. It's the one thing people have converged on through all of history. And it's very likely that that still acts as an anchor in people's minds. And maybe he's right, but I don't know. I don't know that answer, right? None of us do. And that's why the reserve protocol is great, because you can give people the options to use whichever thing they want, and hopefully the best thing will win out, right? And so I think, you know, we have seen people move to better money over time, and so it's a great goal to be creating better money that the reserve protocol is working on. I think that's awesome. I think we can learn some lessons from the past, a main one being, look, markets work, right? When we have a market in gold, they did a good job of producing the right amount of money to be able to grow over time. So I think we want to do that, and lessons from free banking about, you know, being careful and how those banks acted and not over-regulating, I think is a big danger. And so I think like the question of an individual asset or a basket is an important one, and I'm glad you guys are thinking about it, but I really think the flexibility of the reserve protocol is something that is very valuable, and I hope allowing that competition will allow you guys to create the best money possible, and I hope you can change the world. Thanks very much.
All right, excellent. Yeah, thank you again for that wonderful presentation. Super fascinating. Number of different topics I'm curious to talk about. So let's see, where should we start?
Yeah, you guys too, think of your questions. He's got a list here. Right?
Do you still have the clicker? Because there's a slide that I think we should bring up.
All right.
Can we bring that slideshow back up? And can you go? Yeah, I can find it. It's just the chart of the price level with gold. I wanted to discuss that a little bit.
Yeah, before the Fed?
Yeah, okay. Just the gold standard price level chart.
Yeah, so it's stable over time, but it was just
yeah, where we saw the two wars.
Yeah, this one.
Yes.
All right.
So, the inflation, the price inflation in the 1860 to 1870 period. Mm-hmm. Well, okay, so if you go maybe one slide forward to where we see the gold rush.
Oh, sorry.
One slide
yeah,
back.
Right.
Yeah. It's suspiciously right after the gold rush. And so I just wanted to needle on this a little bit because, okay, hear me out. As Joseph pointed out earlier, if you print $1 zillion and just keep them in this room and swim around in them, then they won't affect the price level. And
right.
As soon as you spend them, then they will. So what if people during the gold rush were accumulating enormous amounts of gold, and then as they spent it over the next 10 years, they caused that price inflation? I'm sure you've gotten this theory. So do you think that that's plausible, or is there a way to know that that's not what happened?
Right, so I think it's definitely the case that people that were mining gold, like, I mean, it's like in the movies where they discover some and they're like, oh, I'm so excited, and they go and spend it on all their friends, right? And they have this like giant party at the bar or whatever, and like it's gone, you know. Okay. And then I think you do see like California then starts importing all this stuff. Like suddenly the whole state of California is rich. They're building up cities. They're spending that money. And then what happens is in the early 1860s, once we go to the Civil War, the government then converts all banks from state banks to national banks. I mean, they force them to convert it by making the taxes and regulations too onerous on state banks. But the other thing they do is they introduce the greenback, right? So at this time, there is no Fed, there is no money being produced by the government, but they decide, okay, we're going to suspend the gold standard, and we, the government, are going to print some money. Right? And so they crank up the printing presses, and that's where you have the greenback that is the money issued by the Treasury during this time. And so then you not only have the regular banks producing money, you have this big dump of money that comes from the government as well. And so that's where all the extra money comes in. And then it takes years for basically the economy to catch up to all that extra liquidity that was put in, but also for the government to pay that off. They eventually allowed those greenbacks to be redeemed for gold.
That was my next question. So in both of these situations, we somehow managed to go back
Right.
after going off the gold standard. How do you go back? So, I mean, are you saying you just let the economy grow and, raise taxes and like buy those greenbacks out of circulation, or how did that work?
Yeah, so I mean, that basically is what they did, is that so different countries have done this with different levels of success. The two examples in the United States were, moderately successful. Like if you look at the graphs, it does take like a decade for that to happen. I mean, a decade of deflation is not ideal. And so that was an okay situation. We do end up back on the long-term price level, but it is kind of hard for the economy during that period. And also that economy is recovering from a war. So it's not ideal in that situation either. But there are other cases, like when England went off the gold standard after World War I, they tried to go back on very quickly, and it caused huge problems for them, right? And so they basically like never recovered and had to revalue, and so ended up going off the gold standard because they did it poorly. But in most other cases, like there are a lot of examples where countries in Europe did this as well. And so we just had copied them, where we just said, like, we're just going to suspend. We got to spend some money for a couple of years to make sure we win the war, and then we're going to go back on it. And people believed it, and it worked.
And so it's like you have the same amount of gold and money, I'll do it like this, and then you grow the amount of money, but you have less gold. Then did they end up getting more gold in order to match the money, or less money in order to match the gold?
So a little bit of both. So the new money that's being created is like government money, right? And before issuing that money, they don't have any gold. And so that's sort of one of the reasons that it like after the Civil War, it takes them a while before they're able to pay off those bonds, because they're also not in a good fiscal situation either, to be able to buy up a bunch of gold to pay people for all these notes that they issued. And so yeah, I mean, I think there's like a small enough number that someone could go back and look at those different examples and see what worked and what didn't, but I haven't personally done that, so I don't know all the lessons from it.
Okay. Because I think that this is actually a pretty important question. If we're just thinking on this really big scale of, is it, which compromises should a government be willing to make in order to have, economic stability and prosperity? There is this important question of like, well, if you cause, decades of economic prosperity, but you open yourself up to a situation where other countries can literally beat you in war because you cannot finance wars the same as they can, well, then maybe that's just something that no, world government today would actually entertain.
Yeah. And so, I mean, that's why when I talked about this, I said, like, look, this is a plausible question that I don't have the answer to. Adam Smith, his answer was, look, we shouldn't have the government financing wars through printing money and issuing bonds. They should only be able to finance through current taxes. And his reasoning was like, of course, they're always going to say, this is the end of the world. We've got to suspend all the rules. We're going to have all these emergency powers. He's like, that's what governments do, And it's like, that's what Adam Smith was saying hundreds of years ago, right? So, and his idea was like, look, they do these wasteful wars that benefit the royalty, and all the poor people are the ones that are like fighting and dying and then dealing with the recession afterwards. And so this just shouldn't be allowed. We shouldn't allow the government to spend the gold standard or issue a lot of bonds to pay for these wars. And so again, it's like, I don't necessarily know which one of those is right. I mean, I think that part of it would be going back and looking at the historical evidence and saying, like, what would have happened if we wouldn't have been able to do this? If the gold standard didn't allow this, would we have really lost these wars? I mean, this reminds me of, it's the same thing about bailouts, right? It's like there's always some bank that's like, we're too big to fail, and if we fail, the whole economy is going down. And then the politicians are like, well, we got to save this bank. I'm so sorry, voters, but we're going to have to stick you with this big tax bill, or we're going to have to, suspend the rules for my buddies. Or like, okay, what would have really happened if that bank failed? It turns out there are a couple studies that go back and look at those cases, and they almost always find like it would not have been a big deal. This bank could have failed, and it would have been fine. And so, yeah, the politicians are going to say, this is the huge emergency. We need to suspend these rules and give me more power. I don't know. Maybe that's true.
Yeah. How do they do those studies? Like, do you know what kind of analysis that?
Yeah, like one of them, the very first claim of too big to fail was a bank called Continental Illinois, and they made this argument that, look, if we fail, a bunch of other banks are going to fail too. And so somebody went and looked at their liabilities and the other banks that they owed money to and their sort of network and said, okay, how bad would it have been for all these banks? And they found that basically none of the other banks would have failed, and only a small number would have lost even half of their capital. Like they would have still been fine, lost some money, but not on the brink of failure afterwards. And so yeah, that's the way that they try to do it.
Oh, I will be more skeptical of those headlines in the future.
It's a good idea.
Okay, so you mentioned this possibility that the Fed may have caused the crisis in 2008, or it may in general at times cause economic instability.
Right.
Is that just through sort of leaving the punch bowl out too long, so to speak, or like what can you break down sort of the main
sure.
mechanisms
Right.
by which you think that happens?
So there are a variety of ways, and so actually let me first say this too. This is like an old argument. So Walter Bagehot, who was like writing in the 1860s to 1880s, he is kind of known as the father of last resort lending, and he came up with these rules for lender of last resort. Like, if you're the central bank and you're going to bail out a bunch of companies, here's what you got to do. You don't lend to companies that are going to fail anyway. You charge them a higher interest rate so that they're not just coming for free money, that they really need the money, otherwise they won't pay that high of an interest rate. You make sure they have good collateral. He's got like all these rules, and so a lot of people say like, he's like the father of central banking. But if you go back and read his book Lombard Street and some of his other writings, what he actually said was, look, we shouldn't have a central bank. Like, they shouldn't be in charge. But if we're going to have one company, one bank that's managing the money supply, sometimes they're going to screw it up, right? They're going to cause like a recession because they didn't put too much money in, or maybe they put too much in and caused a bubble. And in that case, yeah, they should come in and act as a lender's last resort because they caused this problem, right? And so to him, it wasn't a situation where the government should be doing this. But given that the government's already taking on some power, they've got to be able to fix the problems that they cause, right? And so if I think about the things that the Fed was doing prior to 2008, so there are a lot of different hypotheses about what caused those problems. There's a couple things that happen. One is we get a housing bubble in the early 2000s. I think a widely accepted explanation is that interest rates were too low for too long, right? Christina Romer that I showed, that's her explanation. I think maybe Ben Bernanke has said that too. If you look at the Fed's, I know you guys talked earlier about the natural rate. If you look at the Fed's estimates of the natural rate of interest in, say, 2004, 2005, they were intentionally putting interest rates below what they thought was the natural rate. So they were intentionally inflating and expanding the money supply. So we know, like, they didn't obviously mean to cause a bubble, but they were overstimulating the economy, and that had negative effects. Another question, though, is, okay, so a housing crisis doesn't always mean a huge financial crisis. How did this extend to a financial crisis? And the answer is all the banks were holding mortgage-backed securities that caused it from being just houses to the whole banking system failing. Why were all the banks holding mortgage-backed securities? Well, it turns out the Fed in the 90s and early 2000s had changed the regulations to encourage the banks to hold more mortgage-backed securities. So they were pushing all the banks to load up on this one type of asset that they thought was super safe, and it turned out it was super risky and basically caused the crisis. So regulation was a big problem. And then the last thing is that once we get into the recession in early 2008, the Fed should have been expanding the money supply to prevent the recession from being too low. And instead what they did was they stopped cutting interest rates, and they actually thought, we've done enough. If you look at their projections at that time, they're like, we're actually more worried that we're going to bounce back and have a huge boom and have inflation, so we don't want to cut interest rates anymore. And in reality, the economy was falling apart at that time. And so they should have been cutting even more. And Ben Bernanke, in his autobiography, he mentions this. He doesn't say, like, we're to blame for this whole thing, but he does say, like, that policy was a mistake.
Okay.
And so all those things, I think, contributed in different ways to the 2008 Great Recession and financial crisis.
Okay. And then, thank you. And so then if we can look at a situation and say, here's the rate that was sort of manipulated into existence, and here is what the Fed at the time thought the natural rate would have been had they not been manipulating. It raises the question of, okay, well then if you just let the market set sort of the natural rate without manipulation in some way or another, is there some reason to think that the natural rate would naturally not cause some sort of crisis on roughly the same frequency, or is there a chance that okay, well, the crisis wouldn't have been then because the rates would have been something less threatening, but if you let the rates sort of naturally crawl up and down, then we'll still end up in these accidental crisis scenarios because I don't know, because the economy's made of humans and they want leverage and then everyone wants extra money, and so weird stuff happens just naturally. Do you have an opinion on that?
Yeah, so I definitely think it's the case that people are uncertain and make mistakes and don't have perfect information, and you can get a lot of people making the same mistake at the same time, but that's not that common. So typically we'll see, like when I talked about the law of large numbers, some people think the price is too high, some people think the price is too low. They tend to get it right on average. And so there could be, at least in theory, a case where all the banks make the same mistake. But if that's happening, then there's a profit to be had from coming in and fixing that mistake, right? Like there's an arbitrage profit. There's somebody that's going to think of, hey, I need to come in and I can make a profit by fixing this. And it's not always clear that that's going to happen, but it means that it's a lot rarer that we would get everyone making the same mistake because you have a good incentive not to. Typically, it's the case that if everyone is doing the same thing in the wrong way, it's because there's some policy that affects everyone, right? That changes their incentive so that they're all now misaligned and all making the same mistake. It's not because they're all dumb, typically.
Yep. Okay. This is not exactly a question, but it just really sort of surprised me when you mentioned that the Fed employs the majority of monetary economists in the United States. I just didn't know that fact. In retrospect, It kind of makes perfect sense because where else are they going to work? But I actually do want to ask, where else do they work?
Yeah.
And how is it that the Fed has the majority of them?
So a lot of them are college professors, but they have affiliations where they're a consultant or they are somehow involved with the Fed and they write papers with people at the Fed. And they have relationships. They're not like full-time employees. But the Federal Reserve is huge, right? They've got 12 regional reserve banks, and all of those banks have big research departments. And now they try to do a bunch of things that they shouldn't be involved with, like public information things, essentially education programs to try to educate people about inflation and what it means and whatever. And I don't know that stuff's very effective.
Sounds like a good thing though. Why do you think that's bad?
Because I think that they're not. So first of all, they're not good at teaching people about inflation. Most people they don't care. They go to the grocery store and they see the prices of the things they buy every day. They go buy gas and see the price at the pump, right? And they don't care about what the Fed is doing or who Jerome Powell is or whatever, right? But I think the Fed is engaged in a lot of things that are not germane to its mission. I mean, part of it is things like getting involved with climate change and other stuff that's has nothing to do with monetary policy. But the Fed also has a fantastic art collection with a number of art curators and all these weird things. Why are you doing that? All these things that should have nothing to do with the central bank. And so that's a problem because all that steers them away from their main goal, right? They're just not focused on doing a good job with monetary policy.
Okay, I'm going to ask you a couple of questions about free banking, then we'll open it up for the audience.
Great.
So you mentioned that during the free banking period in the US, that example, that banks would regulate each other. Right. And that they were sort of better able to do that because they were themselves banks, so they sort of knew what to look for. But I was curious, what did it mean for them to regulate each other? Do you just mean that they were assessing each other and deciding sort of who to do business with, or did they somehow sort of exert control over one another? How did that work?
No, right. So that's a great question. So a lot of the things that are regulated, that are government agencies now, originally started off as just groups of people getting together to try to get stuff done, right? And part of this was stock exchanges, right? Like New York Stock Exchange, there was originally a club where people got together and we want to trade these stocks, right? And so we're gonna I don't like the word self-regulate because it makes it sound like I'm regulating myself and that then I can like break the rules and there's no one that pays. It's like co-regulation where I regulate you and you regulate me. And so if we're the New York Stock Exchange, we're like, everybody that wants to be part of this club, you got to put up a certain amount of money, you got to follow these rules, there's no cheating people, there's no manipulating the market, like, and we're going to set the rules. And those people that are participants, they probably know better about who's manipulating the market and how it works. Whereas now the government is in charge of all that stuff, and they don't really know, right? And so if you have this club where people are worried, like, I'm going to lose all my money if this other company cheats me, your money is on the line, and you have a reason to try to take all the precautions that you can to make sure that we're all being fair and we all have enough money and we're being safe. And banking is the same way, right? Like, they have these clearinghouses where they all get together and we're going to trade banknotes, and I might have a bunch where you owe me some gold, and so I need to make sure that you are going to have that at the end of the day. And so we're going to regulate each other. We're going to have some auditors that come in and check how much capital everybody has. Auditors are going to check, like, what are you invested in? Are you taking a bunch of risky loans, right? We want to make sure that that doesn't happen. And we still see that to some degree today. So you have like private deposit insurance companies that provide insurance to banks, but they're going to go in and audit the banks. They audit the banks like, I can't remember the number, but 3 times more often than the FDIC does or something, because they have their money on the line, right? And that too, I think, is it okay if I say like one other thing about deposit insurance is another thing. Like, this is a great example of when the government is doing it being different than when the private sector is doing it, right? So the pre-Fed period, and in fact the state level period before the Civil War, like, great example where some states are going to require banks to have private deposit insurance. Some states are going to have the states do the deposit insurance, and others are like no requirements at all, right? And so, the reason that might be problematic is because of moral hazard. Probably a lot of people have heard about this, but like, the idea is, if the deposit insurance is intended to cause the problem of bank runs, that everyone knows the bank doesn't have 100% reserves, and so if they worry the bank's going to fail, then they want to run to the bank and take their money out before it fails, which means everyone runs to the bank to take their money out, and then the bank fails, right? And it might even be that if you see someone else's bank fail, you're like, oh my God, my bank might fail too, and then I run to my bank, right? Mm-hmm. And in theory, it could cause contagion in the financial sector. In the real world, that like doesn't happen, but you can think. If the government promises people, look, even if your bank fails, we'll give you some money, then they don't run to the bank and take their money out because they're like, who cares? The government's going to write me a check anyway, right? But you could also have a private insurance company that's going to charge you some amount, and if the bank fails, you still get a check, right? So we can look and we can see, okay, if you have a private company, you're still safe, but if you have, the other part of this is that if the banks know that people aren't going to run on the bank, then they're going to take more risk, right? That's moral hazard. It's like, I know no one's watching me to make sure I'm safe. They know they're covered by deposit insurance. Therefore, I, as the bank, can take more risk, right? And so then there's an empirical question of, all right, which of these things is worse in the real world? On one hand, deposit insurance is going to reduce bank runs and then reduce bank failures. On the other hand, deposit insurance is going to increase moral hazard and then increase bank failures. So we can look in the real world and see, does deposit insurance reduce or increase bank failures? It turns out there's a ton of studies on this. One is in this pre-Fed period where you got all the different states, and they find that more government involvement in the deposit insurance system leads to more bank failures and financial crises. Another way to look at it is, right now, in countries around the world, it turns out the United States is one of the few countries in the world where the government runs the deposit insurance system completely. In most countries, there is some kind of semi-private system where the government says, you have to have a deposit insurance, and the banks run it and regulate each other. It turns out those systems work better. If we look around the world today, countries that have more government involvement with the deposit insurance system have more bank failures and financial crises. Right? And we can also look at individual countries when they get more deposit insurance, they have more bank failures than they do. So it's like a ton of evidence that says that, like, even though in theory deposit insurance could be good, if it's run by the government, it creates bank failures.
I love that you've just taken the time to actually look at all these examples so we can just talk about the empirical evidence. And that relates to my last question, which is, with this idea of allowing people to use any currency and allow them to sort of compete in a sort of Hayekian sense, has anyone tried that? And like, what does it even really mean to do that? Like, you know, are there you know, in the last 100 years or in sort of situations that seem relevantly similar to what we're in today, can we point to the best examples of that experiment being tried and what actually happens?
Yeah. So there's a bunch of things that are like kind of like this, but never the perfect example that you would want to look at, right? So like one thing is dollarization. When we look at all these countries where their central banks are not responsible and are creating a lot of inflation, people want to move to something more stable. And if they can, they often move to the US dollar. Of course, the government, knowing that, tried to prevent them from getting hold of dollars. So the government wants to not allow dollarization. And in some cases, the people just do it anyway, and the government can't prevent them. In other cases, sometimes the government will decide, like, okay, you're right, we've been irresponsible, we don't want another crisis, let's just use the dollar, right? And so we do see cases where people will want to switch to the superior alternative. You know, in earlier periods where within countries you were allowed to trade any currency, you know, you kind of get that too. That's mostly not allowed within current countries today, but you can see it at the international level where in international trade, people want to use the most stable currency. People talk about dollar dominance all the time. Dollar dominance, I think, really has a couple of different aspects. One is U.S. political pressure. I do think that they, you know, use pressure to get other countries to use the dollar more. Another one is the network that the U.S. has that we trade with all these countries. You know, that's not as strong as it used to be, maybe. But it is stable. The US dollar is relatively stable compared to a lot of other countries, right? And so a lot of, if you're in a country that's not trading with the US, if we're in two non-US countries, we might still trade through the dollar as a vehicle currency just because we know it's going to be stable. But there's another country that is even more stable, that is Switzerland. So the Swiss franc, even though it doesn't have the network and it doesn't have the political force that the dollar has, is widely used in international trade. I can't remember the numbers, but it's like Switzerland's like the 30th largest country by GDP and like the 6th most widely used currency in international trade because it's so stable that even though the dollar is like widely used, people that want stability will use the Swiss franc instead. So we have a bunch of like not perfect but good examples of where people want to switch to better currency if they have that opportunity.
Yeah, cool. Okay, great. Let's open it up to some audience questions.
I answered them all.
My question is around depositor safety in the free banking era. So if you don't have the Fed to step in and backstop things, and you have like private depositor insurance, I mean, from a consumer perspective, like how safe actually is that?
Yeah, so again, there are like a bunch of different mechanisms that you as a consumer might use or the bank might use to protect themselves from failing from a bank run, which means they're, you know, ensuring that they're going to be able to pay you back, right? So, you know, these are all used to varying degrees and in different regions and different ways and stuff like that, but one of the examples is they can suspend redemptions. Sometimes there's an option clause in the notes that says redeemable on demand unless we don't have enough reserves. And if they're running out of reserves, they just close the door and say like, look, we'll pay you tomorrow. We're gonna take a loan out from another bank. Tomorrow, your money will be here. You can come in and get it, right?
That's pretty bad from a consumer perspective.
Yeah, maybe. So, I mean, depending on like, it's better than your bank failing, right? So I mean, that's one mechanism. Like trying to prevent runs is the first thing that they want to be as safe as they can. They want to convey to the public that they're as safe as they can. They want to, like in some instances, either you have a clearinghouse or maybe you have a banker's bank that can be a lender of last resort. And so preventing yourself from failing is like the best way to be immune from having a run. But in case there is a run, like telling someone they can get their money tomorrow is potentially better than saying it's gone, right? And then so you can also have private deposit insurance where if you're worried about that, you can go to a private company and you can pay for insurance yourself. I mean, you're paying for government deposit insurance too, right? And so there's a question of, does the government give you a better deal than a private company? That's not clear, but yeah, there are ways that you can protect yourself too by getting your own private insurance, unless we make all these things illegal, right? If the government says, we're doing deposit insurance, does that make you safer? Maybe. Again, it's a problem if you can't get to your money, right? It makes that bank more likely to take risk and more likely to fail, and therefore you to not be able to get your money. The government's not going to be like immediately there. It might take 6 weeks or however long till you get your money. You know, so it's not clear that the government solution is better. It's like a compared to what kind of question. So yeah, so you know, none of these things are perfect, and different regions and banks and governments are all experimenting with different ways to solve that problem. And you know, most of the time, the market solution is better than the government solution.
I know Milton Friedman said that inflation is a monetary phenomenon, but in the chart in front of us in the pre-Fed era, to what extent were those periods of inflation a result of increasing the money supply versus an increase in the velocity of money from individual soldiers, spending money at bars, and the government spending money on guns and boats and
right.
Things like that?
Yeah, so I mean, I don't know that I don't know if there was a change in the velocity or not. I mean, you could also think it might be the opposite, that if people are worried about the future, they want to hold more cash balances and not spend their money. They want to like save it. And so I just don't know as a historical matter what happened with velocity during that period. I would say actually the other thing is, I think I mean, I know that if you look at the monetary aggregates, it's mostly a monetary phenomenon. It could also be that like after the war, you have sort of supply shocks, and that also drives up the prices for non-monetary reasons. And so, I wouldn't be surprised if that played a role as well, but I think it's very close to being related to the money supply.
So, two questions, but the first one just more crypto related. Barton Biggs, like famously was critical of gold, basically. He wrote a book, Wealth, War, and Wisdom, mostly on like World War II through a financial perspective. It was pretty critical of gold as a means of private wealth preservation, mostly because if you tried to pay me a gold coin now and I didn't know you, I have no way of proving that it's real or not. And when you're doing gold outside of the context of the state, generally, like when you're using gold for transactions outside of the context of the state, generally whoever has the biggest gun ends up with the gold. He ended up kind of trying to argue that like medium-sized farms were the best form of wealth preservation. Bitcoin doesn't have these characteristics, and an argument that people make around Bitcoin is because you can prove that you own it without actually exposing yourself to the risk of it getting stolen. And you can also verify like whether or not it's real quite easily. Do you view Bitcoin as something that could displace gold on like a multi-decade to century timeline? Yeah,
so some people are talking about Bitcoin as being digital gold, right? And that's a pretty common thing for people to say. When I talked about the gold standard here, like I said towards the end, like it may sound like I'm trying to push the gold standard, but I'm not. I'm just saying like historically some of these things, like this is why it ended up being so commonly used and is a big advantage. And definitely there are some people that think, yeah, we should just switch back to gold, and it's better, maybe even than crypto, because it is a hard asset that you can use. But I like crypto and I like Bitcoin, and I mean, I think to me, I think Bitcoin is very valuable, and it has like some things that are great to be used as money, and in some ways it's actually better to be held. So I mean, the reason I say that is like, okay, so like Bitcoin right now, some people are trying to use it for transactions, but a lot more people are buying it as an investment, right? But if you do something like, Reserve, where you make redeemable tokens for that, like maybe you can have both, right? Maybe you can hold on to Bitcoin and trade it or something. In fact, Hal Finney talked about banking on Bitcoin, right? And that was his idea. Like Bitcoin's going to basically be like gold in the vaults, and then we're going to have these redeemable claims that people can trade, and it's much easier. And so I think like that seems pretty plausible to me still. I know some Bitcoiners like hate that idea and don't want anything that could be related to DeFi or anything near the Bitcoin protocol, but it doesn't have to be, right? It doesn't have to change the protocol at all. It can, again, be built not necessarily as a specific L2, but in the sense of, you know, having somewhere else like Reserve where you can hold it as an asset and then have tradable claims. So I mean, I see that Bitcoin could fulfill a lot of the roles that gold had before, both in terms of spending and being held as a valuable asset, the way people hold gold. So yeah, I think of it as a pretty good substitute. I don't know, does that answer your question? Is that?
Yeah, I think so. Yeah.
Okay.
All right, we have time for one more question. Looks like Thomas.
So earlier you mentioned in the free banking era, some of the keys were light regulation and low barriers to entry. In addition to low regulation, what are some other low barriers to entry that are important?
So during this period, I mean, historically in a lot of countries, it's like very difficult to get a license to open a bank. In a lot of countries, you have to be like royalty, or you have to know someone that knows the king, and the king's gonna like actually sign every single bank charter. In the United States, we had some states during the free banking period that were basically like that. Like the legislature verified every bank, like it was an act of Congress in the state to create a new bank charter. That is not a low barrier. That's very, very difficult. And of course, the people that get those bank charters are then the ones that have great connections, right, and can get it passed through. Whereas other states, it was just like, sign here, all right, here's your charter, great, you're done, right? That is competition. I mean, and that's not different than in states today. Just getting a business license in some states, some countries, like impossible. Whereas other places, you know, Houston, you can get in like an hour, right? And so having that kind of access to being able to open a bank and being able to come in and compete was really important. The other thing about being able to diversify versus states where you have a unit bank and you can literally have one office and no other offices, you can't even diversify within the state, well, that doesn't make it very competitive, right? And so that, it makes it not competitive, and it also makes it like riskier because they can't diversify, right? And so that's just not a very good system. And so low barriers to entry and lower regulation were really important to encouraging competition.
Awesome. Well, thank you again, Thomas, for your time. Really appreciate it.
Thanks very much.